Deven Choksey also joins in with his perspective on the markets. Deven, good to have you on the show. What are you scanning through on your phone this morning?
Yes, good morning. Well, we on one side we have a good amount of, I think, corporate earnings coming up, and fortunately the corporate earnings are remaining steady and I think growth providers. So from that perspective, I think there is no asking for any fundamental kind of a check on the market. Fundamentals are remaining strong as far as I think the corporate sector earning outlook is concerned. Economy is also, I think, in a strong what you call wicket as far as I think the numbers are concerned. Yesterday we saw, I think, even the CPI cooling down. At the same time, I think the performance across, I think, on the GDP front, the situation is, I think, quite okay. What is not okay as far as I think the market mood and the expectations are concerned, we have significant amount of headwinds continuing. On one side, if the Iranian import of crude oil is basically a breather for the world market as a whole, particularly for the large consuming countries like India. On the other side, I think Saudi country is deciding to basically cut down the production and I think maintain the crude oil prices to around $75–80, so which is not sounding good, particularly because when the crude oil demand itself is not growing beyond 1% in a year. I think this price, I think, are difficult to sustain in all logic point of view, but it is still there at a higher levels. Against which you have the America probably in December trying to raise the rate of interest. If they do so, then probably again the dollar as a currency will gain the strength, and weaker currency like rupee, I think, would probably once again find itself into the victimization state. So all of these headwinds are not letting market remain comfortable, and as a result of which there is a continuous selling pressure, particularly from the ETFs from the global side in the market, and that's where I think we are remaining largely range bound and the upside is not sustaining in the market currently. So we tell clients, I think, to not venture into big trade. Probably I think try and look at, I think, quality stocks at the lower levels, and the market fall is giving an opportunity.
Deven, why are you convinced that earnings are strong? I've read 3 reports in the last couple of days. CLSA, Citi, Morgan, all of them are making a case that earnings for FY19 have to be slashed from 20% to 10%. The earnings recovery is not what everybody projected. Now, we can talk about a TCS or a Reliance or, an ICICI Bank, but the broader market and for the Nifty, the earnings are only getting downgraded. We start the year with a 20% expectations. By the time we wrap out the year, it's 8–9%, and then we start the year again with the promise of 20%.
So Nikunj, I think if you look at the larger part of the earnings coming also from the Nifty basket also comes from the commodity space, and the commodity space is basically most vulnerable to this kind of volatility into the crude oil prices. We believe that on one side we have the cost pressure coming up into the system, as a result of which I think the commodity players are probably not getting the delta on a quarter-over-quarter basis for their products, which is basically putting pressure on the margin. On the other side, the commodity consumers, they too get affected. Say for example, automobile companies, due to the pressure coming up from the commodity prices, I think automobile ancillaries would increase the price, and auto companies may not be able to pass over the complete price to the end consumer, given the kind of a situation in the market where the credit growth for the consumer is getting slower down because of the NBFC related problems. Now, if such kind of situation happens, on one side you have the cost pressure, on the other side I think the market demand is remaining flattish. So auto companies also come into trouble. On the other side, I think we hear that the China has already started scaling down the chemical product prices, and they have started relenting on the pollution norms that they had imposed, I think, couple of 1.5 years back. So from that perspective also you see the commodity prices are creating a kind of a disturbance into the situation, and as a result of which outlook on the earnings side from the commodity companies and commodity consuming companies, I think it is remaining uncertain. That is the reason for which I think across the board you can't be giving the guidance for the earning growth. Maybe I think earning growth guidance can be given only for selected sectors in the companies therein.
Right. Deven, just hang on with us. I just want to quickly mark the pre-open rates. Remember, we're working with a backdrop of a pretty adverse global scenario. But for now, it started off with green ticks around the 10,470 mark on the Nifty. You've got the Sensex up about 137 points. The currency as well merits mention. 72.77. That's where it started off today. Remember, yesterday it fell below the 73 mark, but then managed to recover to end around the 72.90 level. That's where it started off in trade right now. But Deven, wanted to draw your attention as well to what's going on within the PSU banking space. Just, yesterday we had Bank of India coming out with its numbers, and I think pretty much on all parameters it was a bit of a howler, although the asset quality to a certain extent did improve. It was a massive net loss of 1100 odd crore rupees. How are you looking at the PSU banks as a space? How have you read into the kind of earnings that we've seen, and what's the take?
So in general, I think the PSU banks probably are now entering into a phase wherein they are recovering the earlier provided non-performing assets. The NCLT route is definitely helping them in recovering the funds faster than before. Fortunately, strong economic situation and inflow of stress asset funds coming in through the asset reconstruction companies from the global side is basically also helping in bringing down the haircut, which was earlier envisaged at around 30 to 60% depending on case to case basis. Now currently the situation is that in some of the assets cases, I think the haircut is probably not there. In fact, I think in some of the cases you have started to seeing some amount of premium being paid for those assets being acquired by the stress asset funds. So if this is a situation which is coming up and playing its role, in that kind of a scenario, the public sector banks we have earlier been provided with the non-performing assets, they are now receiving funds, and at the same time their ability to lend money is improving. All the same, I think you are also having a situation wherein they are in a position with this liquidity, they are in a position to buy out some of the assets of non-banking financial companies, particularly housing assets, I think, which are being acquired by some of the banks. So yes, I think the situation is improving. Whether it will improve lock, stock and barrel one at a go, I don't know. I don't think so. Maybe I think I would segregate PSBs into two parts. The mid and the small tier PSBs on one side and the larger PSBs on the other side. Larger PSBs are relatively giving more comfort vis-a-vis the mid and the small players. I think probably mid and small players likely to get folded into the hands of the larger players eventually. So that's an area where I think one will keep an eye as far as I think the upside in the stocks is concerned. So we are remaining careful, watchful, and at the same time I think positive because of I think the situation improvement which has taken place in case of public sector banks.